Hey guys, it's Saturday evening, 6:54 p.m. I just wanted to make a quick video asking for your advice and your opinion and your help and thoughts on what I should do. So if you know from my last video, I currently own 400 shares of AMD at a cost per share of $51.75. So I was assigned those 400 shares because AMD fell below my strike prices yesterday, Friday, end of day. So now I have 400 shares of AMD, and like I said, my average share price is $51.75. So to run the wheel strategy, we know I have to start selling covered calls. Now, when the market opens Monday, these prices are going to change, but I think we can at least plan to see what I want to do when market opens Monday, given that the proportion or the relative difference in premium values should stay roughly the same. So what I can do is I can sell a weekly covered call, May 8th, and just collect a quick premium and then hope that the AMD shares get called away. So I freed up about $20,000 worth of capital, so I can put that into other options the following week. Or I can try and hold on to the shares and just keep running covered calls on them as long as possible. And depending on what I want to do, I also have to pick a strike price. So, for example, I need to pick a strike price at least $52 because I don't want to sell these shares at a loss. So $51.75, $52 is the next strike. So if I sell the covered call for this Friday for $52, that's right now it's 69 cents per contract. So that means, roughly, if I have 400 shares, so that's going to be 4 contracts, and that's times 100, obviously. So immediately I would collect about $276 in premium, plus $52 is 25 cents higher than my cost per share at $51.75. So I would also earn 25 cents in stock appreciation if AMD gets to $52 or above by Friday. So that's another $100. So that'd be $100 plus, what did I say? 269 times 4. No, that's not right. 269 times, no, 69 times 4, 276 plus the $100. So that covered call would get me $300. We can write $300. Now we can do the same calculation with the $53 strike price, for example, if I go a dollar higher. So that would collect roughly, 46 times 4, 184. Plus now it's going to be $1.25 appreciation, right? Because $53 minus $51.75. So it's 184, 125 times 400 shares, 500. And what did I say this was? 384, 46 times 4, 184. So it's going to be 184 plus, my memory is so bad, 125 times 400 plus 184. That's going to be $684. If AMD gets to $53 by end of day Friday. Now what if I did $54? So it'd be 32 times 4, it's 128. I'm going to do a better job remembering that. And then it'll be $2.25 in stock appreciation. So $2.25 times 400 is $900. 32 times 4 plus 900 is $1,028. So $1,028 if AMD gets to $54 per share by Friday. Now let's do one more at 55. So that's going to be $3.25 of appreciation times 400 shares, $1,300. And then 22 times 4 is $88. That's going to be $13.88. It's going to be $13.88. So basically, if any of these four things happen, I'll get this much amount of money and the shares will be called away, which I kind of want to happen. Now, the other option is I could change the expiration date and go longer out. So I could do, let's say 45 days out, which is going to be roughly June 19th. And now you'll see that these premiums are much higher overall, right? And the difference in prices between the strikes is $2.50 now instead of $1, because June 19th is the monthly cycle. If I go one up, or let's say I go to June 12th, it'll go back to the $1 strike. But let's just do June 19th, just because the monthly cycle is probably going to be more liquid. But so now let's say I choose the $52.50 strike price, right? Because that's still above our cost basis. And so that is going to be, let's see, so $52.50 minus my cost of $51.75 is 75 cents per share times 400 shares. It's $300 plus 310 times 4, 1240 plus 300. That's $15.40. I'll write that on this side. So if by June 19th, AMD is above $52.50, I'll collect $1,540. Now I probably won't end up holding that till June 19th. I'll probably close out around 50% profit because I don't want to hold this much collateral, hold this much money tied up for 45 days because I can't do anything then. I can't trade with any other options if that money's all tied up in AMD. But I mean, I could even go higher out and say the $60 strike price. Like, let's say I'm bullish on AMD and I think by June 19th it's going to be $60. Well, then to calculate that, 60 minus 51.75, that'll be $8.25 of stock appreciation per share. It's $3,300 total plus 112 times 4 plus 3,300. 37.48. So this is going to be 37.48. So if I sold this one, I would collect immediately 112 times $4. Oops, 112 times 4. I would collect immediately $440 in premium. And then if AMD is at $60 per share or higher by June 19th, then I'll collect an additional cash to make it up to $3,748 and the shares will get called away. My only concern is that I don't know what the market is going to do right now. It's so volatile. What if by June 19th the market starts dipping again? Then I'm definitely, AMD is not going to go up to $60. AMD is going to start going down. So I'm going to end up bag holding my 400 shares, although I will still have my $448 in premium. So that's what I'm leaning towards right now. That's why I'm leaning towards the short weekly strikes instead of the 45 days out. I mean, in theory, I could still sell this covered call for June 19th, just hold it until this Friday, and then get out of it. And then let theta decay do its work and see what my profit is at that point, because I mean, I'll collect $448, but I'm gonna have to buy it back, and a good chunk of that is gonna go away when I buy that share, when I buy that contract back. So, I mean, let's say that contract is $400 on Friday, then I'll only have profited $48. And I'm just making numbers up. But let's say if I go to 60 on the weekly May 8th, it's $7. So, chances are, if I collect $448 in premium by selling that covered call, to buy that covered call back, I would have to pay $7. So the profit is still pretty good, but I don't know what I want to do. I'm leaning towards selling the weekly, at least initially, just because the market is really volatile right now and nobody knows what's going to happen. And I don't want to get caught with $20,000 tied up in AMD. And then the question is, which strike do I sell? If I do the $52 strike for $300, there's a pretty good chance that AMD will get to that point, even if it pretty much trades sideways, because it's at $50 right now. So I'll net $300 for that week, which is not bad at all. I mean, that would be about $300 on roughly $20,000 worth of cash that's tied up. So that's a return of about 1.5% in a week, which is really, really good. Or I could gamble a little bit more and go to the $53 strike, collect a little bit more premium, but then chances are higher that I might get stuck holding those shares. I don't know, right now between $52 and $53 strikes. Let me know in the comments what you would do. If you have any better ideas, please let me know. And always, thanks for tuning in. If you have any questions or comments, feel free to leave them below. Please like and please subscribe. I really appreciate it. I'm trying to grow my subscriber count so I can monetize this channel sooner rather than later. And as always, happy trading. Thanks a lot.